So the stock market has really rebounded quite well to the weakness that we had at the beginning of September, as the market is starting to price in what I think largely is widely expected as a rate cut, and maybe and now actually more likely a 50 basis point cut on Wednesday. We've seen precedent for this before, specifically on September the 18th of 2007, where there was also a 50 basis point cut to kick off that rate cut cycle. And the market did very well on that September 18th and did pretty well afterwards too. Obviously not for very much longer, but still, at least in the immediate aftermath of the beginning of the cycle, the market responded very favorably to that, as we would expect it would here too. As you can already see, the market starting to price that in over the past week or so. So a nice little rebound. Again, we saw a rebound just last month. And so the question is, is this a rebound that actually will go up to new highs, or are we going to peter out like we did last time and just kind of stall and go sideways for a while and work around? Of course, Wednesday is going to have a big factor in that, but we'll kind of take a look today at how things move today and see whether or not they are pointing towards more of a sustained rally in risk asset classes and risk, the XLK, and XLYs, but specifically XLK. We'll take a look at that sector rotation. We had a very odd day today, very low volume, very small range day, but a boatload of breadth within a small move. We had probably one of the most extreme days of breadth on a single day basis that we've seen. So I'll kind of show you what that looked like and what that means and whether that is something that may be sustainable or not. And then our trade idea is a stock in that tech sector that, remember, we really need to outperform. And we'll talk about this stock is not, and it's actually moving in the other direction. And we'll talk about how to trade that considering a recent earnings move. So let's go ahead and get started. Today is Monday, September 16th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. Alright, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video. This is where I take a look at old trades, see whether we should stay in them. We've actually closed out a few over the past few live videos. So check that out. We also put on today's trade already before the market closed. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. Hit that like button. Again, the more you do that, it helps get our content out to all of our followers on those platforms. So thank you to those who do that day in and day out. Those who don't, you can do right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, over the past few days, including Monday here today, we've had a 6-day winning streak on the S&P. So a really good rebound off of that bull tag, coming up to and close to retesting the all-time highs like we did back here at the end of August, and we set in the middle of July. The intermediate line you can see is up there above in the upper reversal zone. The near-term line remains at extremely bullish levels. The momentum line dipped into oversold levels. So that combination there of the oversold momentum line with a bullish intermediate line is a bullish intermediate confirmation signal. Now, it would be better if the near-term line was itself below the chart's midpoint or in bearish territory itself, and obviously it's not. So it might not be necessarily producing a new near-term run right now. Like those are the ideal intermediate confirmation signals. But it does mean that we might continue to get more of a near-term. This near-term run might last a little bit longer. They typically last 7 to 12 days. We're at 6. So we might end up being more on the longer end of that rather than the shorter end. So we'll see how that ends up playing out. You can see the NASDAQ 100 Did not finish higher today, so if it lost its losing streak, I don't think it's too worried about that. The intermediate line is turning higher again in bullish territory. Is not in the upper reversal zone yet. Never did get up there either during this run that we had in August. The near-term line came down because of the loss today, but not out of the reversal zone yet. Its market sentiment line is actually still falling in the lower half of the chart, no less. Remember, if the near-term line crosses the intermediate line, when the intermediate line is between the reversal zones, that can be a bearish crossover to the downside, kind of like this one was over here. So really important to kind of watch and see if that bearish crossover occurs tomorrow, heading into FOMC meeting right on Wednesday. The intermediate line did get up above the market sentiment line in between the reversal zones and stayed above it. So there's a good chance that we can maintain some bullishness. Technically, this is the intermediate confirmation signal as well, because we have dark green shading, but still it's not as strong as when the intermediate line's in the reversal zone. Then you have much better bounces off of these oversold momentum lines. Excuse me. Let's look at the Russell 2000, and you can see here its intermediate line's actually barely crossing by the 50th percentile. So it's nowhere near the reversal zone, and it didn't get there either here in August. Did at the end of July. The near-term line's probably the most bullish out of all of them. It took a while to get going, but it finally really crossed through and made this bullish peak. The momentum line dropped, but not into oversold territory. And you can see the intermediate line's actually crossing above 50, but still below its market sentiment, which is actually slightly rising. And back to dark green shading and a green line here as well on the moving average. Now that it's rising, we're over 2.5% up above. But you can see we've had these kind of fits and starts, but never really good significant trend because we can't get the intermediate line into the reversal zone. Strong, but this is a much stronger near-term line than we got any of these other instances. So we have a good chance that this one can actually make it there. Again, barring a significant reversal following the FOMC. But again, that's not the precedent, right? The precedent is on FOMC day, especially with a rate cut, that the market rebound or goes up pretty significantly higher. And that's what we'd expect to happen this week as well. Finally, let's take a look at the Dow Jones. Dow Jones actually did get a new all-time high today. And you can see its intermediate line again in the reversal zone. Great. The near-term line strongly bullish. Great. And your momentum line's down, but not too extreme. So we're set up pretty good. We got a bull tag, and we bounced off of it to new highs. So that's a nice little. So now, hopefully, it's not short-lived like the last bull tag that bounced ended up being. So we'll kind of get an idea of that again after this FOMC meeting. To see how much longer we'll continue to go up. We expect that we will go up immediately after the announcement, and we expect we'll go up some after that too, because that's the initial market reaction to rate cuts, is to be bullish. The question is, kind of like what I tweeted out here. The bullish case for the Fed is that they only cut once every so often. Right, what we don't want to see them doing is cutting indefinitely at every meeting. 50 basis point cut here, a 25 basis point cut maybe at the beginning of next year, another 25 basis points maybe next summer. I mean, that's the bullish scenario for a soft landing. If we start doing it at every meeting, starting with 50 and this going 25 at every meeting to next summer, then that has traditionally not been the most bullish scenario. But even in that worst case scenario, after the first cut, the market tends to rise for weeks, like multiple 1, 2, maybe 3 weeks after, including a really good strong day on the actual day of the cut itself. Let's take a look now at the weekly chart and see how we started off this week. You can see after two transitions, remember transitions don't typically, when you get multiple transitions, they don't typically lead to a reversal. They typically lead to a continuation pattern. That's kind of what we got here. Back to a kind of a bullish pattern. It's not the strongest bullish candle. It's pretty small, but still it's bullish. So, it's better than not being bullish. Looking at the three green arrows, you're back to three greens on the Dow. You're back to three greens on the S&P and the Qs. And today you're back to 3 greens on the Russell. So 3 green arrows across the board now after a few days of being pink on the S&P and a little bit more on the Russell and the NASDAQ. And we never did get 3 red arrows at all on the Dow Jones Industrial Average. If you take a look at the 2-line version, again, we had broken below the 30. We've rebounded. Got back above the 8 last week, and now we're clearly above the 8's back above the 17 itself, which means the MACD is up. Again, this is probably not going to be the strongest momentum move because we've already had a strong momentum move and a peak on the MACD. So we're probably going to have smaller momentum moves, kind of like what we've seen before. So this is probably going to be the extent of the momentum, and we just kind of grind up here to the upside. If you take a look at the DMI, you can see, again, both lines below 25, so we still don't have a clear trend to the upside yet on the DMI. The RSI and the CCI are not necessarily bullish. We're not back above 60 yet here, but we're still green because we never did drop below 40. We're not back above the 100 or even like 150 would be preferred to kind of really get a good thrust, a good intermediate run going. We don't have that as either. The Ichimoku cloud, when you look at the strength of the trend, we do not have even a weak trend developed, even though you are above the green line. You're above the cloud as it's turned pink. You got a very strong positive rate of change over 26 days. So everything else looks good there. You just don't have a trend at all going down there. And then finally, looking at the Bollinger Bands and the Keltner channels, we are up in the upper quartile of the bandwidth, but still below the Keltner channel. The bands themselves still inside of the bandwidth. The bandwidth has really dropped off pretty sharply. So again, kind of following the same idea that we're at the top end of this range, but we need to break out if we're going to get a trend, and we still haven't broken out obviously yet. As you can see, no 4-week high point today, but we're a lot closer to the high than obviously the low or even the midpoint. Obviously also very top heavy, so we need to avoid breaking through any of these lows at all. To avoid anything down to the downside. It's looking like we might end up getting a one touch. We've seen a couple of these one touches that ended up being pretty bullish before. This is very much looks like very likely to be a very similar one touch on this, as well as we saw on the diamonds. We do have the new 4-week high point, and then IWM, you can see we got a new 4-week low point, but now again we've rebounded that we're a lot closer to the high than we are the low right now. So we're not out of the woods. It could be a one touch. We're not for all of these, but we need to get closer to the highs if we can, if not actually get a new 4-week high point. Let's take a look at today's range and volume. You can see both numbers on the light side, 3.21 points on the range and 36 million on the volume. Very, very low numbers. When you put those numbers in the context, 3 points is way below the 52-week range. The volume's way low. And we are below the 1.5% mark, but we have not crossed the 1% mark yet to really trend to the upside. And then if you look at the volatility index, this is the key. Again, we're back below this 90% mark. That's bullish. We haven't broken 15 yet, which would be kind of ideal. And then the VVIX still remains very strong. So again, it's all the FOMC. So the VVIX is still kind of saying, hey, there's still a possibility things can go a little sideways. The VIX itself, when you look at its where it's sitting, it's also still, it's below these short-term averages, but still above the 200. You really need to break back below that 200 if we're going to be actually trending to the upside. So we are still kind of susceptible according to the volatility index. And you see that as well on the skew. When you look at the skew, it also is still very high, too high for something that is bullish. To kind of start off a new bullish move. We're almost at 150 again after dipping a little bit below, and that you can see the average is close to 150 as well. So not the best sign for the skew to be rebounding as much as it did there. We prefer for it to get, start off at a low point and then move higher, so that we can get a good trend going instead of already being so high when we, at what may be the beginning stages of an intermediate run. But the problem is this is not what the skew looks like at the beginning stages of an intermediate run. It's more what it looks like towards and maturing stages of an intermediate run. All right, now if we take a look at what's driving a lot of this price action, so let's pull up the asset class comparison chart. You can see, of course, the safety trades have been doing so well over the past 3 months, but let's look at just today alone. So we'll drop down here to September, not August, September 16th, and look at today alone. You can see, again, not necessarily the most risk-on day here. Bonds were up today, which means yields were down significantly. We'll see that here in just a second. Commodities did very well, which is not the combination you typically see. Usually yields and commodities move kind of together. You can see real estate, international stocks did well with weakness in the dollar. Dollar really kind of dropped there. And you can see the Qs were the worst performing asset class. If I were to go back over the past week, right, when this whole kind of rebound started up to the upside, ultimately we retested the low point on Wednesday morning, but since you can see the Qs have been the big winner, so not surprising it'd be a loser today when it's been such a big winner going into today. IWM has been kind of following. It was lagging for a good chunk until Friday. It had really rebounded on Friday and kind of made a big old catch-up trade there. Weakness in the dollar recently, especially the past couple of days, has really helped lift gold up. And like I said, bonds have been doing pretty well too. So if I were to take a look at some of these charts, if we take a look at the dollar index, it's really been dropping, and it's moving back lower to the downside, and MACD and stochastics are rolling over. Bonds have also been, look how strong of a move that is. If we take a look at the 10-year yield, let's just go to a daily chart. Look how much of a drop. We're down to 3.62% on the 10-year yield. In fact, even the 3-month yield has dropped quite a bit, which is reflecting increasingly higher odds that the Fed will actually start with a 50 basis point cut on Wednesday. Instead of just 25, you're at 69% odds of a 50 basis point cut. You're at a 94% chance that by the end of the year we get a 50 basis point cut in one of these 3 meetings. And like I said, by June of next year, which is only 9 months away or so, you're looking at so to get back to where we are for a 200 basis point cut, we're looking at 6.4, so almost about a 93.5% odds that we'd have 200 basis points of cuts all the way through. So basically a cut at every meeting, with one of them being 50, and it's looking likely that it could be September that ends up being 50, but then a cut at every single meeting after. Again, that is not typical of the soft landing. Soft landings, you get a cut, you wait a few months, you get another cut, you might get one back-to-back 25 basis point, but usually they're not like back-to-back. They are kind of one, maybe you get like a 2 or 3 in a row, but then that's it, right? That's what we saw in 2019. We saw that in 1998. Some of the soft landings. 1995 was a very common soft landing we get compared to a lot. It was, the cuts were way spread out over different months. And there was only a few of them there too, like 3 of them as well. So if that's kind of what we're looking for, then we really need to kind of spread out the few cuts we should only get. Unfortunately, the bond market itself, like the 2-year bond market, the 2-year bond market's already almost at 200 basis points away from where the Fed funds is. In fact, when you look at the spread here between the 3-month and the 2-year, if I were to add a 2-year here on the spread, and we'll add that and take a look at the spread between the two. You can just see how low that is, and how just how extremely low that is relative to where it's been in the past. Again, this is a reflection of the 3-month being the reflection of the effective Fed funds rate, on a market basis, and then the 2-year being kind of the path of where the market's expected to go. So this is even saying, hey, remember that the Fed dropped. I think the Fed dropped like 95% there. The Fed funds rate by 95%. It dropped over here by 85%, and you can see how low in the 90s it dropped like 64% of it. It dropped from 90 to 92. And you can see again how low the yield spread was, how negative it was. It's way more negative now than it was then. So, in fact, I mean, you could argue like if we were to drop 64%, then we're looking at by the end of next year being down, say at 2%, which as of right now, I guess would be somewhere in this range. You're looking at really only about a 5% chance of that happening. But again, that would be similar to what we've seen in the past, and so that's kind of what we'd like to avoid, if at all possible, and only have, like I said, maybe one here, because now the Fed's price, the Fed has pretty much telegraphed it. You have to do it because that's their MO. They're very transparent. They don't like to shock the markets. That's why they floated the 50 basis point cut article in the Wall Street Journal they let the market start to consider it, right? So it's not a surprise if they actually do it on Wednesday. So they're very transparent, relatively transparent in that regard. So we'll kind of see how this ends up playing out. But you can see it's really sending bonds kind of through the roof here. They were already very attractive, and now you got a good trend going on right now. As I mentioned, commodities rebounded, and they've had been rebounding. Here's the daily chart. So you can see over the past few days they've been rebounding back up to still very oversold, still below important support levels, but at least coming up off of these lows, so they're not as bad. We'll see if we can break through 70 and get back up. There's a lot of resistance up here, so any move to the upside will definitely be pressured by what's going on. The breadth today was really kind of very abnormal, because I told you that the range was very small. The range was very small, and the volumes were very small. That did not keep us from getting 415 new highs, which, as you can see, is a pretty extreme number. We don't get very often. We've got it a few times here. We got it here at this peak. We got it over here at this peak, and then once more here towards the low. But and you can see some of these other peaks where we got it, and the average peaked. And you can also see too where my cursor is, where the average is right now. It's not too common for the average to be up this high. It usually ends up peaking near these levels. So now we've got both of these both the actual number itself and its average, both hitting very strong numbers on a very light volume day. So a lot of breadth and not a whole lot of oomph behind that breadth. And then you look at the new highs and new lows index, and it jumped up to 700. Again, for some context, it doesn't generally get and stay up at 700 for very long. That's a very, very extreme number, and typically suggests exhaustion in this move. As you can see, the number of stocks above their 50-day moving average, almost back up to 380. And remember, 80% is 400, and we were there here previously at 400. We're back up above a moving average that's rising up here. The number of stocks above the 200-day are also at a pretty decently high level, near 380 as well. Excuse me. The ratio itself almost back below 1, and we'll see if it can get below and stay. See, when you're bullish, you need to drop really sharply below 1 so you can stay below it, and then you can get a good trend starting. Obviously, that's not necessary because we haven't really established an extreme level to the upside that we can kind of bounce off of to the upside. You can see if I zoom out a little bit more, you can see some more context on what I'm talking about here. Like, you get these big, strong moves to the upside, and then you can come down and stay below, and set up a new bullish move to the upside. And obviously that's not the case when you're just barely dipping your toe under 1. It typically sets us up for just a very short intermediate rally up to the upside there. Let's take a look at how the sectors perform today. So we'll come up to the sector comparison chart. And again, just look at today alone. So we'll come out here to September 16th, and we'll come to the 5-minute chart. And you'll see again, financials, energy, materials, communication services, a couple dollar sensitive areas, utilities, healthcare. Again, these XLK and XLY didn't do so well. But again, they didn't do so well because they had been doing so well, right? They've been the biggest winners during this rebound. That's not surprising that today they take a little bit of a breather, but that's just one day, and it's not necessarily the biggest issue. And as long as, it's kind of what I've mentioned before, as long as XLK is outperforming the markets, and you can see the nice little rebound we've had here, then great, right? We need to get the momentum and relative strength lines back both above 100. We need to get above the 50-day average. We're not quite there yet, but that's kind of what we need to see on XLK, and then this is what we need to see on NVIDIA, right? We need to see it leading XLK, and it isn't necessarily, right? It's in the lagging category as well, with both lines below 100, and we're not really necessarily breaking above the 50-day average, and you can kind of see what we're doing there. So again, the other bullish thing is for XLK to kind of get back out of this lagging, get over here up to the right, and for a lot of these safety trades to move down. And you can see again the long-term trending move right now is towards safety and away from XLK. Despite a 2 or 3 day run, you can see that hasn't really impacted that, and it kind of goes to show again, whenever you do have a 2 or 3 day rally or a loss, it's good to put it in context of the broader move, which right now would make it seem like it's just a short-term bullish rally in towards technology, and away from some of these areas. But even then, it hasn't been enough on a relative basis to say, oh man, we're doing really good here. And that brings us to our trade idea of the day, which is actually in that technology space. It had earnings out last week, and that is Adobe. Adobe really dropped down pretty hard on its earnings, and then after a couple overbought clusters, no less. But then significant change from extremely overbought on the short-term sentiment to extremely oversold, with the intermediate line now crossing below market sentiment, and both are falling. Still in bullish territory, but they're both falling. You've got that bearish cross, and like I said, very bearish short-term sentiment there. If you look at the weekly chart, we had a bearish candle, a transition candle last week. That was actually a bearish candle. So now we have a bearish candle so far this week, a pretty decent size bearish candles as well, as you can see down there. And we're crossing the Hakinyashi close. As of right now, is flirting with the 40-week exponential, or again, our proxy in this case, in this particular chart, our proxy for the 200-day. Obviously, you have 3 red arrows on Adobe. You can see the 3 red arrows there, and very strong volume because of the earnings announcement. So that's not surprising. Looking at the 2-line version of this chart, you broke the 200-day moving average. The 8 broke below the 17-day. They're both looking close to breaking the 30. You also broke the point of control. So now we got a lot of resistance above us, and the path of least resistance is down to the downside. If you look at the DMI, big break up to 30 on the negative indicator. You're already below 20 on the positive. So the ADX was already pretty high. Now it's just staying high. So we've gone from green to pink shading there. If you look at the RSI and the CCI, you can see they have both dropped to bearish levels, right, well below minus 100 on the CCI, below 40 now on the RSI. And as of right now for the week, we're only 1 day in, but as of right now for the week, we're breaking below the minus 100 level. If you take a look at the Ichimoku cloud, you can see we had a bullish move going, and it's gone. Right, in 2 days, it's gone to 0. We're into the cloud now. We have a negative rate of change. The green line's close itself to breaking below the blue line. And then you can see we broke below both. Both the lower Bollinger Band and the lower Keltner channel. So we're both below the band again. The band width is starting to increase from a very low level, and we're both below the Keltner channel too. And the bands itself, the momentum's turned negative, and we're that close, maybe one more day away from the bands breaking out of the Bollinger Band width. So with that being said, let's take a look at. I decided to do a pretty aggressive bull put spread. So going pretty low on the delta, selling the 485, buying the 490. Keeping my risk very low, of course, because it is a big move already to the downside. But considering that you're breaking the 200-day and that you kind of dead cat bounce, like we've already broken below the low point of that earnings gap, we'll set ourselves a pretty aggressive trade. I mean, this is a very, very aggressive trade. And we'll see if it follows through. And if it doesn't, of course, we'll keep a very small loss. But if it does, we get a very decent reward for a very small loss. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember, subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Monday night, everybody, and we'll see you all tomorrow.